Hey everybody, this is Brent from Wolf on Wall Street Trade, and I have a market update for you for the week ending October 4th, 2019. This was an interesting week, not just in price action. Last weekend I suspected that price action was going to get more volatile because VIX had started to break out of a bullish consolidation. What was more interesting and what was more important on the week was the economic data. Global manufacturing PMIs dumped this week all across the globe, and in the U.S., not only did ISM Manufacturing dump, but the services dumped, and that was a big part of all the price action this week. So like I always do, I'm going to start where I left off on the last weekend's video, and we were right here with the S&P 500. I thought that we would probably test up into the top of this channel early on Monday or early in the week. And just for some context real quick, here's a 30-minute chart. And if you go look at the videos from the last couple of weeks, you'll see that in this area, price actually morphed from bullish consolidations to bearish consolidations. That's the FOMC, by the way. So right after that first knee-jerk reaction into resistance, started getting bearish. And this is the pullback that had occurred up until that point. And the S&P held this 2944 level, which I've been preaching. This is just a key level to be aware of. To this point, as of last weekend's video, price action was bearish and pulling back, but the pullback or the decline here was orderly. And that was one of the things I was saying. VIX was starting to break out, and if that happened, we would go from an orderly market to some bigger moves. That's what happened this week. So back to the 5-minute chart where we left off. And I'm going to walk this forward. So Monday, like I thought, we tested up to the top of this channel, broke out above it. 3C negatively diverged right here in the afternoon. So here we are coming into Tuesday. Now this is a really interesting morning. Futures were up, treasury yields were up, so that looked very supportive for stocks. But one of the main reasons I do the AM update and I include some global data that came out overnight is so you have context. And yields were not up for a bullish reason. Yields were up because in Japan they had a very weak bond auction, and sovereign yields around the world started following those Japanese yields, moving higher. So it wasn't on good data or anything like that. It was on more like this left field factor. And what had happened Tuesday morning before the U.S. opened was South Korea's PMI missed and it went further into contraction. Japan's manufacturing PMI missed, went deeper into contraction. Eurozone's PMIs for September went deeper into contraction, although they came in better than they were feared. And while yields were up, the Australian dollar had plunged overnight. And that looked something like this big plunge, which makes buying this move very risky. And at 10 o'clock, the U.S. manufacturing ISM came out. It missed, it went deeper into contraction. It was the worst print, the worst reading in a decade. And this is what happened next. Got very ugly very fast, plunging on that ISM. We'll just walk along through Tuesday. Look at these small bearish flags, very bearish price action. So kept seeing these as like going lower, kept seeing these, came down to 29.44, and as you can see, right through it. And the day ended with this bearish flag. So that was going into the next morning, Wednesday. Did not look good because we had closes at the session lows and we had this bear flag. So my expectation for Wednesday morning was that we were going to go down more, and that's what happened. Down big time. See, once we broke this 29.44, remember I said VIX was starting to break out last week. Watch out, the volatility in price could really escalate. So here is a big bear flag, and it easily met the downside measured move. Again, these bearish little consolidations between legs down, and this is how we ended the day on Wednesday. Another bearish flag. So one leg down flag, second leg down flag. This points to the probabilities of a third leg down. But one thing we did see Wednesday night was the market had reached a very oversold level. I look at this in terms of internals. I call it one day oversold. And we knew that the non-manufacturing ISM was coming out at 10 o'clock in the morning on Thursday. And what I told my subscribers was that if the ISM, non-manufacturing or services, misses, expect the S&P to break this bear flag, go down towards the 200-day moving average, test that. Or if it came in stronger than expected, expect the S&P, because of that really deep oversold condition on Wednesday, expect it to bounce back up here to the 29.44 level. ISM services missed, and it missed big. So the takeaway from that is that the global manufacturing slowdown moved over to the U.S., And the market hasn't been very worried about it because the U.S. is primarily a services economy, and services had remained pretty strong. That changed on Thursday, so that weakness from manufacturing crept into services or non-manufacturing ISM. And here is the reaction. So, down about 1.4% early in the morning, that first couple of minutes, and we got this really unusual bounce. So on a daily chart, here's the S&P on Thursday. Did not quite make it down to the 200-day moving average, was about 0.6% off, but the Dow Jones Industrials did. And also the NASDAQ, or rather the NASDAQ Composite. So both of them hit that 200-day moving average and just bounced like a bat out of hell. IWM gave up all those September gains and came all the way back down here to the bottom of that August channel on Thursday morning. Another contributing factor, maybe even more important than those technical support levels, was what happened to October rate cut expectations. They soared from 45% the prior week up to 95% Thursday morning. So that was for a 25 basis point cut. You can see how it ended the week up at 78%. So it did come down a little bit, and that was from 49% the prior week. So the takeaway is that bad news became good news because it meant the Fed had to bail out the market. The market thinks the Fed has its back, expecting another rate cut, and that's how we got this bounce out of very, very bad data. And this is how we ended Thursday, so at the bottom of this downtrend channel. And the market was not overbought, so it had a potential, and I said to my members, I think it's going to probably go up and fill this gap and move up to this 29.44 area on Friday, and that's pretty much exactly what happened. Here's Friday, and it works its way up to 29.44, and then at the end of the day, blasts through it on some late day buying. This is the ISM, the manufacturing ISM, so you can see it really topped back here in August and has been going down the whole time. So global manufacturing has been moving into recession, we know that, and U.S. manufacturing had been doing the same. This is below 50 the last 2 months, and this is this week's print. A reading under 50 means that manufacturing is in contraction. And here's the non-manufacturing or services ISM, again, peaking back here in August, September of 2018 and declining, but kind of some noisy bumps up and down, but declining. Here is this week's print. So you can see worst in a long time, worst since August 2016. And again, what this tells us is that the manufacturing contagion or recession is now moving over into services. Here's the weekly chart of the S&P 500. So you can see traded all the way down here, almost to 2850 towards the middle of the week, and then bounced back up Friday, giving us this big hammer, which is bullish because it means lower prices were tested and the market closed higher. So down 0.3% on the week. The Dow Jones down 0.9% on the week. NASDAQ acted the best. It was up almost 1%, so you can see it closed up for the week inside of this prior week's real body. So this is an inside week that is bullish, and you have this hammer which is bullish. And small caps were the worst performing, again, just like last week, down 1.3%, traded all the way down to the bottom of this June-August range that we had been watching. So gave up this entire relative strength. You might recall over the last couple of weeks, I've pointed out that IWM's relative strength over here did nothing more than correct to this trend, which has been relative weakness since the summer of 2018. Actually, the worst relative weakness over here since the financial crisis. So all of the strength that we had seen a couple weeks back, early September, that was just reverting back to this mean. That was it. S&P sectors were mixed on the week, 6 up, 5 down. The worst performing were materials. Energy was the very worst, down 3.8%. Financials were down over 2%. Industrials down over 2%. Transports down 3%. The best performing on the week, and this had really been the case the second half of the week, was technology, up 1.1%, and then healthcare up 0.9%. And for a week that the S&P ended only down 0.3%, the move in yields was just humongous. So the 2-year yield down 24 basis points. That's reflecting market expectations for the Fed to cut rates because the data was so weak this week. The 10-year yield was down 16 basis points. So That's something you would kind of see if the market was down 4, 5, or 6% on the week, and we'll talk about that in a minute. And the 30-year yield was down 11 basis points, so you can tell from the 2-year down 24 to the 30-year down 11, there was a lot of curve steepening this week. We'll get into that in a minute. The gist is that is the bond market saying the Fed has to cut rates because of this weak data. I'm going to run through some trends on these 15-minute charts. So here's the S&P 500. There's the downtrend. Here's this week. Like we said, volatility was breaking out last week, so it opened the door to this kind of move once we broke 29.44, and of course ended right back up there. The thing I want to point out, I call these channel busters. So when you have a downtrend like this, and then you get a false breakout or a failed breakout, what generally happens is you get a fast reversal, and that's what we see here. Now, when this trend is broken to the downside, imagine it kind of like a rubber band. Actually, it's like a rubber band over here too. Can't get any traction. Rubber band shoots it down this way. Once it breaks down here, that is a sign of a very oversold market. It's kind of like a rubber band down here too, and it kind of tosses it right back up. That's volatility. So let's take a look at the Dow. You'll see the same channel over here in the Dow. Failed breakout over here. Big fast reversal, and then up here kind of around this resistance level, former support that broke right there, heading towards the top of this channel. And pay attention to QQQ here. So didn't really break down too bad out of this channel and ended the week again right up here at this former support zone that broke earlier in the week. Resistance now around 189. Now compare this channel, just look at price in this channel, to the IWM, which is coming up here. IWM showing massive relative weakness this week, falling out of that channel once it broke down over here below 152. And even Friday is just back testing the bottom of this channel. So the NASDAQ is up above it, the S&P is up above it, and small caps are below. And the story is the same for S&P sectors. I'll run through some real quick. There's materials breaking, failed breakout, fast reversal, reversion to the mean over here. Energy sector, poor relative performance, like I said in the weekly stats. Again, like IWM down below this channel, just kind of moving back in. And financials over here. Here are industrials. The technology sector, you can see the relative performance there above the channel. This is a different trend, consumer staples. Let me zoom out a little bit here. So while the market has been selling off, this has been more kind of sideways. And then you have utilities, which have been acting great, right? So while everything else is kind of chopping around sideways or going down, utilities have been making consecutive new record highs. They did break down this week. This was an interesting development because what happens is when the market gets really scared and deleverages, they throw the baby out with the bathwater. They sell everything. And when you see that happen, that is generally a sign of, one, an oversold market, but two, typically it happens right before bear markets. We did see this happen in December of 2018, so that happened right about here. We got this first little breakdown, and then we knew it was going to get really ugly because the defensive sectors got sold as well, and that is when this came. Here's consumer discretionary, here's the communication sector, and here is real estate. Again, a much different trend over here. Eyeball the S&P 500 and this channel where it is relative to the channel, and now let me show you the 10-year yield. Notice where it is, like IWM or small caps, under this channel. So this is a big divergence between the S&P 500 and yields, and that is a negative thing for the market heading into the next week or two if that doesn't resolve. And quickly on the whole channel buster that I was just talking about, when you go break below one of these channels and you get into a very oversold market. I'm going to show you an example of that from December. This is the first leg down in October of 2018, and then notice this channel in QQQ. So I was short. I like to be short on the first breakdown in small caps. They usually react first and worst, and then after we get a consolidation, I like to move my short over to NASDAQ because it usually is the tech sector that holds up on the first sell-off, and then on the second sell-off, it really gets walloped and catches down. Note this channel. Here we are around mid-December. Let me zoom in a little bit. I'm short NASDAQ here, and I decided to get out of NASDAQ on the short when it broke down below this channel. So a lot of traders would say, well, why are you doing that? It's just starting to move now. When this happens, you are in such an oversold and dangerous position for a sharp rebound that I would rather take the profit and leave a little bit on the table rather than get caught in that. Here's crude oil. Here is the big 15% spike, biggest spike intraday in crude's trading history. That was when the Saudi oil facilities got attacked, and crude just acted real bad from there. Remember, we looked at this bear flag, said this is not how crude should be acting, and that broke down. This is how we left off the last week. I said it had not met my measured move target on the downside. It had more to go, so we'll roll forward, and this is this week down. Look at all these bearish flags intraday. That is telling me, you know, if you're short this and you see these corrections, these bearish flags, I just stay short something like this because price action is telling you it's going lower. And how did we end the day on Friday? Right there, another bear flag. So the entirety of this big spike on that Saudi oil attack was wiped out. Bear flag, down, another, down, and another, and that leaves crude susceptible to more downside next week. Last weekend, I showed you gold, GLD, and this price pattern that I didn't like. I said it looks like a head and shoulders top. It's not really a head and shoulders top. But the point is that gold was making higher highs and higher lows, and then it didn't over here. So that is the tone or the price action turning from very bullish to not so bullish. This is a concept to be familiar with. When support is broken, you see a back test. That's pretty common. So that's what we're seeing this week in all of those channels. Former support becomes probable resistance, or in IWM's case, down back testing into this channel. That doesn't mean price has to stop there, but it's one of the first likely areas of resistance to be encountered. So for gold, here's the back test, and it did break out above that. Let me go to a shorter chart, let's say a 5-minute chart. Why did it break out? Because of that bad data. Expecting rates to go lower, data came in bad, and this is how it ended the week. Not so bad. Kind of looks like it might be a bullish flag developing. If so, it would look something like this, so you don't want to see price go back below this 140 level, otherwise this whole flag would be completely nullified. And if it were to break out above this and start another leg up, I get a measured move about 3.5%, or probably up here around 147 for GLD. So you can take that and define your risk reward. I would say your risk would be a move below this level, which is about 140, and you have a potential target up here at 147. So from where we are here, about $2 of risk and about $5 of reward. So that's not quite 3 to 1, but just depends on where you actually get in. For me, the lower it is in this flag, as long as it stays above this level here, the more attractive it becomes because I have less risk over here and I have more potential reward. I mentioned this week's yield curve steepening earlier. Let's take a look at that because that has some pretty big consequences, impacts moving forward, especially if you're looking at the market from a much bigger picture, broader perspective. So first, let me show you what happened. This is the S&P 500's 5-minute chart, and this is the 5-year, 30-year yield curve. So here you can see this week, S&P down, steepening really sharply. First over here on Tuesday with the weak ISM manufacturing, and then here into Wednesday, Thursday on the weak non-manufacturing ISM or services. So a couple of things. First, from a short-term trading perspective, this steepening can be beneficial for the banks. So let's say the regional banks, they tend to be most sensitive. You can see they will follow the yield curve generally within 1 to 3 days. So you get this sharp steepening here. You should see banks probably make a move to the upside following this steepening. And if regional banks make a move, that means IWM or small caps is going to be influenced by that and make a move. So what we might see in the next week or so is that IWM's really weak relative performance the last 2 weeks may turn into some relative strength versus the benchmark S&P 500, and it may be led by the banks. So that's the bullish side of it. Now, if we look at it from a broader macro perspective, it's very bearish. Here is the 10-year constant maturity minus the 2-year. That's the 2 and 10 spread. This is a long-term chart going all the way back to 1976, and this is recession shading here in gray. I've highlighted the area where the yield curve would go into inversion here in red. So this is the warning when yield curves drop and they go into inversion. That's a warning that you are looking at a very, very high probability recession, usually about 12, 16, 18 months out, something like that. So that is the warning. It is the steepening that is the killer. Notice what happens here right before the recession. The curve steepens out of inversion, happened back here, happened again over here, happened again over here. So I think of it this way: flattening into inversion is the warning, the steepening is the trigger, and that generally steepens because the Fed cuts rates. So we've already had 2 rate cuts this year, and as I've pointed out in some past videos on this subject, the last 2 recessions that we had back here and over here, this is the financial crisis, both of those were almost 3 months on the nose after the Fed's first rate cut. The first rate cut was the end of July, and look at the data. Look at the PMI, the ISM, they're all tanking. And finally, from a big picture perspective, absolutely nothing has changed. We still have this very large broadening top in the S&P 500. You could disagree whether or not it's the top, but I don't think there's any mistaking that this is a broadening top, which is defined by higher highs, which we have all over here, and lower lows, which we have over here. Here's the area of that broadening top, and this is the count of new 52-week highs on the NYSE. And this is what a bullish market should look like, advancing new 52-week highs. Notice what happens when we get into 2018. After this first plunge, they really fall off. They don't recover. And into 2019, they are advancing most of the year on this rally. Let's zoom in a little closer. And notice that they peak over here in June after Powell went dovish. Here the S&P 500 makes new record high, new record high. What's happening with new highs? They're going down. Over here, just recently in September, almost hit the record high over here is less than 1% off. What's happening with new highs? They're going down. And the only reason they peaked over here was because there was a rotation into defensive sectors, and the defensive sectors have been making new 52-week highs. So what I've done is taken the S&P and I've overlaid an equal weight index of the FANGs. Remember in 2017, that's all you heard every single day. The market is up, the FANGs are leading. So if we take a little closer look at the October high last year, what we see is they started to break down right here before the broader market did. And then into 2019, what are they doing? They're making lower highs relative to the S&P 500. That means they are not leading. From William O'Neill, I think this was in Market Wizards. Just check out the highlighted portion here. If stocks that have been leading the bull market start breaking down, that is a major sign the market has topped. That's what we're seeing here. The FANGs are no longer leading like they were all of 2017, 2018. Now here is the same equal weighted list index, but these are the 3 defensive sectors. So what we saw into early 2018 was they were not leading. It was the FANGs that were leading. They weren't leading over here. But coming into 2019, they started really leading. So what are the only sectors making new record highs? Well, utilities is right there at the top of them. So instead of the growth FANG-oriented stocks, it is the most defensive stocks now that are leading. That's a major shift in tone in the market. And here's what 3C has to say on a longer term daily chart. 3C was making higher highs, higher lows with price until we got into the 2018 top over here. And in 2019, what is it doing? Still making lower highs and actually some lower lows too. Usually you have 5 pivots in this kind of a pattern. 1, 2, 3, 4, and here is 5. So as I said last week, this last rally didn't quite make it up to this upper trend line, which is around 30.50. That 30.50 level is not static, so say if we went on another quarter, it would move up to here about 3100. But the point I was making last weekend is that you really have minimal upside and you have a whole lot of downside just getting back to the next lower low without even breaking this top. Just to give you some idea, going from about where we are right now, almost 27% in downside, and you have maybe, in my view, about 4% of upside. Of course, anything can happen. Over this weekend, we can get a tweet and something changes. But right now, we're looking at probabilities. Okay, so wrapping this up, my target from Wednesday night and Thursday morning was this level up here, 29.44, which is also right around where the 50-day moving average is. You can see just closed right above that. We filled that gap. That was my expectation on an oversold bounce. I think IWM could do a little catching up to the other averages because it saw a real weak relative performance this week. So maybe, come up into here, 151, up here to 152, something like that. Just so you know, here's the trend line that I have marked out for this bounce off of Thursday's low. So that comes in somewhere right around 29.40. In the next day, it'll be up here around 29.44. So once again, 29.44 is going to be a key level. I like being able to short into price strength. I never open new shorts in a market that is not only down like this, but as we saw about midweek, extremely one-day oversold as far as internals go. And while I'm on that thought for members, Friday's stats came in with a very strong one-day overbought. Thursday, we had almost all the conditions for an overbought market, except advancers weren't more than 2-to-1 over decliners. So on Friday, advancers were almost 3-to-1 over decliners, 11 of 11 sectors up. Volume fell quite a bit, so only 720 million shares on Friday. And finally, the dominant price-volume relationship was close up, volume down. That is the weakest of the four. Everything is in place for a one-day overbought condition. That is how we ended on Friday. So maybe we get a little gap up, a small candle, maybe a shooting star or hanging man or something like that, or a doji star. That would be my expectation for either Monday or somewhere early in the week, being that we do have a overbought condition in just 2 days. On the currency front, remember it was the Australian dollar that led the market down these last 3 weeks, and specifically on Tuesday when the market gapped up and the Aussie had plunged overnight. So as I mentioned earlier in the week, the Aussie came right down to the bottom of this August range. Found some support right here. You can see those two long lower wicks. And this 60-minute chart shows it a little bit better. Here's that turn down that brought the entire market down. And here we are into Tuesday, I think it was, of this week. There's support. So it's been supportive the last 2 days. The dollar-yen pair has been catching down to the Australian dollar versus the US dollar. It entered last week in a supportive position for stocks and then broke this trend. I think that was Tuesday. Bear flag, more down, and comes down here. So you can see it's doing the same thing as the Aussie with support there, but it's not quite leading like the Aussie is or supportive of stocks. It just isn't leading lower. And here's the dollar versus the offshore yuan. Got into the risk range over here last week. So China has been on vacation most of this week for the golden holiday, and the yuan has bounced a little bit. So it is down below that 713 range. So that is better for stocks heading into the U.S.-China trade war talks that will be next Thursday and Friday. So all of that is pretty supportive for stocks. The one place that is not, Treasury yields, and that's one of the most important places. Here's the S&P 500 again, that channel 15-minute chart with the 10-year yield. There is the FOMC knee-jerk reaction that yields did not participate in, led lower. So the bounce that we've seen this week on Thursday and Friday in the S&P has not been confirmed by yields. So ever since that ISM report came out, first the manufacturing over here and then the services over here, stocks have gotten an oversold bounce, and I think that's all it is. Yields are not buying the enthusiasm whatsoever. So you can see this big negative divergence. That is very risky. Everything else looks pretty good for the market going into next week. That looks very risky. So either yields come up and kind of converge with the S&P, or we have a really nice short setting up with some tactical signals. And what I mean by that, it could be the Aussie turns down, it could be the yen turns up, it could be 3C turns down sharply. Any of those things, we're already in a pretty good position here near some resistance to be able to sell the S&P, and yields are confirming that. Just need those tactical signals to line up. So I'm not going to speculate too much, but I've pulled this chart forward. Remember, the trade talks are Thursday, Friday. They'll be right in here. And then after that, we get to the FOMC. So my guess is next week into those trade talks, we kind of just have some low volatility price action until the trade talks Thursday, Friday. then we could have some major volatility either way. This is a 30-20 resistance, or way down here, which is 28.24, and that is pretty close to where the 200-day moving average is, around 28.40. I know that's a really wide range. All I'm trying to get across is that we have a big event right here with the trade talks, and then we have the Fed over here. I think we'll be kind of quiet into the trade talks, open for some big volatility after that, and then quiet into the Fed and big volatility after that. Keep in mind that the Fed cut rates here, stocks sold off, and the Fed cut rates right here, stocks bounced a little bit and sold off. I think what has really become clear with the data this week is that the Federal Reserve is not cutting rates as a mid-cycle adjustment or an insurance cut like 96, 98. It looks, as I've suspected, as I've covered in these videos in the past, it looks like a full rate cut cycle that goes hand in hand with a recession. All right, that'll do it for this video. Thanks for listening. If you like it, please give it a thumbs up. Feel free to leave comments, questions down below. And stop by the website at wolfonwallstreettrade.com. I will put the link below. Some of the posts that I do daily or in the week for members, I will occasionally post those for free, so everybody can kind of check that out and get a feel for what we do in the morning, the afternoon, and night. Thanks a lot, everybody. Have a fantastic weekend.